The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A 7-day run for the S&P powered by what else but AI. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. Let's take a look at where we stand right now. More green on the screen. Like Romaine said, this could be a 7th straight day of gains for the S&P 500, up about 0.4%, driven in a big way by AI, by OpenAI, not a publicly listed company, but really making a splash in the stock market. The Nasdaq 100 higher by about 1% right now. Folks are selling bonds. This is a risk-on day. The 10-year Treasury yield higher by about 4 basis points right now. We're at 4.15 on your 10-year Treasury. But volatility coming out of the equity market right now, Romaine, down a little bit on the VIX, though I will point out we are trading with a 16 handle. Yeah, you take a look at the top of the screen, though. It is about OpenAI. Remember, it was just a week ago when OpenAI sent Etsy soaring 16% after unveiling an instant buy e-commerce option in ChatGPT. AMD getting its turn on the carousel today, rallying the most since 2016 on OpenAI, deploying 6 gigawatts worth of graphics processing units over multiple years. Figma, HubSpot, Cisco, and Mattel also rallying on comments at an OpenAI developer event. Such public market-moving sway from a still private company, rare, but it highlights rising influence that's good for OpenAI. But for everyone else, maybe not so much.
It's quite an interesting thing to wake up to this morning. We have a company that's giving away 10% of its stock to a startup that doesn't have positive free cash flow to buy tens of billions of dollars of their products somewhere down the line. And that company's stock is up 30%.
We'll get back to that story in a second, but elsewhere, bonds globally are in sell-off mode. Yields higher with longer-dated bonds steepening the curve anew, initially sparked by the now 6-day U.S. government shutdown. Then you have France's formation and collapse of a new government in just 24 hours, the likely ascension of a pro-stimulus prime minister in Japan, all heaping further pressure on sovereign bonds. So where are the safe havens today? Well, where else? Gold, the precious metal, which a year ago was around $2,500 an ounce, today flirting with $4,000. Bitcoin also in the mix as well, topping $125,000 over the weekend. Debasement hedges, if you will. Katie Greifeld is growing concern about fiscal conditions keep people away from those traditional safe havens.
Absolutely. Well, with that in mind, I thought it'd be interesting to take a look at correlations here, specifically gold and the S&P 500. Gold is in yellow, of course. Then you have the S&P 500 in white. And you can see these two lines have been moving higher in tandem, not typically the relationship you might expect to see. You would expect that when the white line goes down, gold would go up and vice versa. But right now, the 3-month correlation between these two asset classes is just about at 0.9. So very, very correlated between what's supposed to be a safe haven asset and a risk-on asset. But as this chart shows, you take a look over the past couple of years, this relationship typically peaks in October, the month that we are currently in. In which direction it peaks, which asset class sort of breaks out of this dynamic, Romaine, I can't tell you, but keep an eye on this chart.
And of course, everyone right now keeping an eye on that chart, keeping an eye on the markets, and of course, the shutdown in Washington. For a better read on what's going on around the world, let's bring into this conversation Ted Koenig. He's chairman and CEO over at Monroe Capital, and he joins us today here in New York in Studio 2. Great to have you here, Ted.
Thanks, Romaine. Good to be here.
We should point out, you guys, $20 billion under management right now, a big focus on middle market companies at a time where we're not getting official economic data. So that means basically we're all looking at people like you to kind of tell us how the economy is going, particularly through the lens of some of your companies that you're invested in.
Yeah, it's interesting. We've got about 520 companies in our portfolio. I call it middle America, mainstream America. Average EBITDA, $30 million. And fascinating, what's going on here, the ride we've had. Ever since we were liberated in March up until now, we've seen a lot of a dichotomy in the haves and have-nots. Consumer goods, hospitality, companies down, but software businesses, healthcare businesses, business-to-business services up. I call it anything that requires a container to come into the country. Those are things you want to stay away from right now. Things that don't require containers, that are more business-to-business services, that's where you want to be.
For the things that do require containers, I mean, what is kind of the longer term outlook for those names? Is it that they ride out whatever tariff trade issues we're going through and maybe they find a way to adjust longer term?
Yeah, we've got to figure out where the bottom is. You know, right now there's been a lot of volatility there. M&A can't happen if there's not certainty. Financing can't happen if there's not certainty. We need to be able to project certainty into the marketplace. After that period, we can underwrite. You know, we can underwrite high interest rates, low interest rates. We can underwrite COVID. We can underwrite, you know, all kinds of recession issues. But it's hard to underwrite when you don't know where your costs are.
It's interesting to hear you say, you know, you can underwrite in a high interest rate scenario, in a low interest rate scenario. What you need is certainty. But let's talk a little bit more about that rate picture, because the market seems pretty certain that we're definitely going to get one, maybe two more rate cuts this year. We got the first one, of course, just about a month or so ago. How has that factored into Middle America, the market that you're looking at right now?
Well, there's two things that are happening. One, we're trying to heat up the economy. The administration is clearly trying to heat up the economy by encouraging rate cuts. You do rate cuts when you have a situation where you've got big unemployment, where you've got revenue issues, where you've got macroeconomic headwinds. The challenge is we're doing rate cuts. We're talking about 2 more rate cuts this year and possibly 4 more next year into a market that's already hot. The stock market's flying. There's lots of money sitting on the sidelines with private equity, private credit. So the biggest challenge, I think, that we have to be mindful of is inflation. That's our enemy. We're starting to see, you know, unemployment numbers that indicate rate cuts, you know, may be a good option. But the other side of that is inflation. Look at egg prices, look at cereal prices, look at air travel prices. All of that is higher than it should be today.
Yeah, absolutely. At the consumer level, I mean, the cost of living is still a serious problem there. The Federal Reserve trying to thread that needle now, of course, without the benefit of government data. But when it comes to where you're sitting and you take a look at the different sectors across your portfolio companies, I mean, where do you have conviction right now when you consider these different cross currents?
Well, listen, you guys talked about it just now, AI. AI is on a run and there's no looking back. I'm concerned that, like anything, there's going to be winners and losers in AI. I mean, some of the valuations of these companies, you know, I'm a fundamental investor. I shake my heads. What I like, though, is the infrastructure around AI. That's what we're focused on. Power, energy systems, delivery, engineering, things that AI needs in order to create infrastructure. So I like that. Healthcare, outsourced healthcare services. With all the federal cuts that are happening right now and the state challenges, a lot of healthcare is going to be outsourced. Those outsourced companies are going to be places to watch. I'm concerned about hospitality. Anything that consumer hits, we're starting to see credit card defaults. Credit cards go up, that's a sure sign that you're going to see stress in the consumer market. I'm concerned about fourth quarter stress in consumer.
I am curious, given just your background. I mean, Monroe's been around for 20 years, so you've seen a couple cycles, but obviously you had a career before that. So you've been through different business cycles, economic cycles, market cycles. How does this compare, what we're going through now, to what you've seen in the past, if at all?
You know, it's interesting. Yeah. Like I said earlier, we've got a unique situation right now. We've got a stock market that's trading at, you know, 27 times PE. You know, average over the years, 17, 18 times. So by any stretch of the imagination, we're at high levels of valuation. M&A on the sidelines. You know, look at 2019, look at 2021, you know, we're at half levels of M&A. And, you know, we're in a market that we should be. I mean, last year, you know, we were rocking come fourth quarter and first quarter. You know, after second quarter this year, M&A slowed down and just stopped. You know, we've got a portfolio, as I said, of 520 companies. 80% of our M&A was through our portfolios, add-ons, tuck-ins, bolt-ons, dividends, refinance, not new M&A.
Right.
And I'm hopeful that once we get to fourth quarter, there's a lot of pent-up demand that we're going to start seeing some M&A. We saw a big one announced this morning. I think we're going to start seeing more. We need certainty. The business community needs certainty.
Right.
And when we get certainty, the market is poised for M&A. There's a lot of private equity that's been sitting now 10, 12 years that needs to get unwound. Secondaries, we've not ever seen a secondary market like we're seeing today. That's because LPs want their money back. Universities, Harvard, Yale, Stanford, they need their money back so they can fund their budgets.
It's interesting to hear you say that, that you have still M&A not back to levels that, you might expect it to be when you put that in conjunction with what we're seeing in the IPO market. This current stretch aside, given the government shutdown, but you have seen IPOs come back. Typically, public listings and M&A, they're mentioned in the same breath. But to see this sort of break apart, that one has come back, the other hasn't, how often do we see this sort of dynamic?
Look where that IPO is coming from, though. That's the secret. It's technology. We're seeing software, we're seeing technology. That's where we're seeing M&A today. It's not the core U.S. distribution, manufacturing, service industries. And we need to get back, we have a service economy. And for services, we need jobs, we need certainty. And that's where, when you start to see job growth in those service economy areas, what I'm concerned about is, kids, grandkids of my contemporaries. AI has not been written yet, the final chapter. It's great. You're seeing valuations, you're seeing all these wonderful things happening in terms of data centers being built and valuations every day, new unicorns.
Yeah.
AI is going to take jobs. People aren't talking about it, but I see it today. Consulting firms, big four accounting firms, law firms. Those are entry-level jobs that trained much of corporate America. So the challenge for us is to make sure that we're creating those types of jobs that are able to train young people so they can go on and achieve great things like a lot of my contemporaries have.
Yeah, absolutely. Well, hopefully we get there. I do have one final question. Are you more bullish on AI or the Chicago Cubs right now?
Listen, I'm a Cubs guy, and I'm rooting for them. These damn Milwaukee Brewers really took it to us. I know how the Yankees fans feel right now.
Yeah. I'm not a Yankees fan, so I'm dancing. Ted, great to have you.
Thanks, Romaine.
Ted Koenig is chairman and CEO of Monroe Capital. All right, when we come back here as we count you down to the close, we are going to focus in on M&A and one of the biggest deals for financial stocks this year, Comerica and Fifth Third. That's coming up after the break. This is The Close on Bloomberg.
Certainly, the indications that there are accelerated merger approvals are an important consideration here. With that said, Fifth Third was approved to bid on the failed banks in 2023. I'm pretty confident we could have gotten a deal approved, in the prior administration as well. It's just nice to know that the process here will be fact-based, but expedient if recent outcomes are any guide.
That was Tim Spence, the CEO of Fifth Third Bank, discussing the timeline of the bank's agreement to buy Comerica for about $10.9 billion in stock. Now, that acquisition will be the largest U.S. bank deal this year. Let's bring in Herman Chan with Bloomberg Intelligence to break it down for us. So this combination, it creates the 9th largest bank in the country. Tell us what Fifth Third gets out of buying Comerica.
Sure. So Comerica represents a geographic expansion for Fifth Third that's mostly in the Midwest historically and has also moved increasingly into the Southeast. It'll bring Texas and California to its branch presence, and that's really where they want to grow, particularly in Texas. Fifth Third had mentioned opening up 150 new branches on top of the existing 100 branches that Comerica already operates.
I remember as a couple years ago, or however long it was ago, when we had the whole Silicon Valley Bank fallout, there was a lot of discussion about potential consolidation in this space. I mean, what's changed? Is it just a new administration is maybe emboldening these companies to finally kind of pursue these deals?
Yeah, I would say that's one of the primary reasons. The secondary reason is that we have higher stock prices across the board for banks, so there's more currency to do deals. And you've seen that with the really stronger players like PNC, Huntington, Fifth Third use their currency, using their stock to buy smaller banks in growth their markets like the Southeast and Texas.
And so when you think about the Comerica side of this transaction, so Fifth Third, of course, they get that geographic expansion. Comerica, I see that you wrote that this wasn't entirely unexpected when you think about some of the issues they were working through on their side of things.
That's right. So Comerica really shot itself in the foot a little bit as interest rates rose. They hedged their revenues, and it really has suppressed their top line growth over the past couple of years. The deal is a capitulation on that because of the lower profitability and resulting higher efficiency ratio and higher expenses. So this helps reset expectations for the Comerica existing P&L, and it'll help Fifth Third going forward.
I am curious as to, I understand why you would have two banks of this size sort of want to combine. Is there any potential where we see M&A where we see the bigger banks going for some of the smaller banks, or is that just there's no real advantage for the bigger banks?
Yeah, the bigger banks are sort of precluded from doing traditional M&A deals just due to their size, right? They have trillion-dollar balance sheets. They're ubiquitous in the larger markets. So the banks like Bank of America and JP Morgan are really focused on growing organically and opening up new branches in new markets that they're not in currently. And so that's one of the reasons why these larger regional banks are focused on M&A, because they see banks like JP Morgan going into their hometown, like in Pittsburgh for PNC, for example. So PNC is also growing outside of their traditional geographic footprint just to create a more stable deposit base and grow their operations.
Well, to that point, Herman, who else should be on our watch list for potential combinations here? Is this the start of an actual trend? Because like Romain said, we've been waiting for this for a while.
Yeah, I could say that the trend has started now after Comerica's deal today with Fifth Third. We've seen PNC buy First Bank, which is in Arizona and Colorado, and we've seen Huntington, another large regional, buy into Texas with its Veritex deal. I think the questions will be on some of these other larger regionals, like at MNT, Key Corp, Citizens, Regions in Alabama. The questions will come from analysts trying to decipher if they're now more acquisitive after some of these peers are being really active and aggressive in expanding.
All right, Herman, great stuff. Herman Chan, the best of Bloomberg Intelligence, a closer look at one of the biggest deals of the year, certainly the biggest in the financial sector. Comerica shares up 13% right now, which point out regional bank stocks as a whole having a pretty decent day as well. When we come back, though, there's still a lot of concerns right now about the U.S. government shut down for a 6th-day. A big question right now about what's actually going on behind closed doors and, well, what happens when those doors finally open. Jared Bernstein, former chair of the Council of Economic Advisers, is going to be joining us after the break. This is The Close on Bloomberg. All right, the U.S. government shut down, continuing into its second week. And in his latest piece for Bloomberg Opinion, Jonathan Levin writes, the lack of data from the shutdown leaves businesses, investors, and others groping in the dark for signals about the economy. Jonathan joins us right now to talk a little bit about all the groping going on right now. Jonathan, I mean, we had Representative Emmers on, I don't know, last week, basically saying you don't need U.S. government data. You can just look at all the private data. But does the private data really stack up?
I don't believe that at all. I mean, first of all, like let's take the ADP release last week. The thing about ADP is this, like so many of these other data sets, is at the end of the day, it's tuned to BLS data. In fact, there was a major note in there that said that this latest print was affected because they were re-benchmarking to BLS data. So at the end of the day, you know, we can get a couple weeks, we can maybe go a month without this government data, but alternative private sector data is not ready to stand on its own 2 feet. And then, you know, I could go on and on, Romain. There are just a lot of things that the private sector is never going to measure for us. Maybe just because there is no profit motive. I mean, you know, sure, like these big macro stats, there are a bunch of providers at this point, but, you know, like take vulnerable groups in various parts of our country, take rural populations. Like there isn't necessarily a profit motive for people to go out there and do a great job of measuring these things, but they're very, very important for policymakers.
Right. No, it's an important point, and it's a conversation we've been having about how complete a picture you can put together about the economy when it comes to these alternative sources of data. But bring this to policymakers. Like you said, this is a really difficult environment for the Fed to operate in. October 29th is the next Fed decision. It's October 6th right now. Not too much movement yet. So, I mean, how does the Fed, when they next meet, even if they have delayed data on their side, what might that conversation sound like?
Yeah, obviously it gets a little bit trickier here. It's not the end of the world. But look, as any user of this data will tell you, they're never 100% anchoring to one data point. It's never about BLS's employment situation report versus ADP. It's in the world we live in today, you want to have the full constellation of data. And you're never going to weight one thing 100%, you're never going to weight another thing 100%, but you want to have the full constellation of data, and you weigh in with the inherent uncertainty in all of these things, and at the end of the day, you make a decision. And that decision just becomes so much harder in an environment like this.
I am curious, Jonathan, I don't know if you even have a response for this, but there's been some concern that even if we do end the shutdown and reopen, that there's certainly been a certain, I guess, if you will, dismantling, if you will, or at least an attempt at dismantling some of the traditional procedures of our data collection and data dissemination practices by the government. And I am curious as to how much faith you put in this idea that when we do reopen, we're going to return to the old ways, or at least the more reliable ways that we've come to depend on.
Yeah, it's such a shame to see this attack going on from the White House to the Bureau of Labor Statistics, because some of the best ways to modernize our statistics infrastructure are coming from within the Bureau of Labor Statistics. And the problem there is not the personnel. The problem is money, money, money. We have seen funding and staffing levels drop across administrations. It's a bipartisan problem. And if we want to continue having the best statistics infrastructure in the world, then it's very simple. We need to invest in it.
All right, Jonathan, great to get some time with you and hear your perspective. That is Jonathan Levin of Bloomberg Opinion. And we now want to bring in someone who knows what it's like to be behind closed doors discussing economic policy at the White House. His name is Jared Bernstein. He's the former chair at the Council of Economic Advisers, currently a senior fellow at the Center for American Progress. Fantastic to have you with us. So we're in day 6 of the shutdown. We're on week 2 officially. Given that you do have this experience under your belt, what's your best guess as to what those conversations behind those closed doors might sound like at this point?
Well, there's a lot of, first of all, thank you for having me on and raising this important topic. And I thought the previous conversation was very helpful as well. There are 2 main conversations that you'd expect behind closed doors right now, or at least 2. One is assessing who's winning. Public opinion is a huge factor in determining how long this goes on and when it ends. Right now, the polling shows that Democrats are doing better than Republicans in this regard, both because people are somewhat moved by the Democrats' message regarding health coverage. It's also the case that 70% of people who are on the Affordable Care Act exchanges live in red states. So it's not quite the clean red-blue break that Republicans would like. And then there's a discussion of just pure functionality. Are we getting what we need? How damaging is it that the data reports aren't coming out? Who's an exempt person? What's going on with things that are huge for consumers, air traffic control, the TSA workers? Remember, they're now working without pay. And that has been a real source of pressure in prior shutdowns. So those are some of the things going on, I would imagine, behind closed doors.
Well, that's what I'm curious about, where the rubber meets the road when it comes to actually determining public opinion. As you say, that's really going to determine who blinks first when it comes to this standoff. So, I mean, maybe missing the jobs report, we care about that. But when it comes to the American public, what are some of the things that we need to keep an eye on as these days and potentially weeks progress?
Well, it's a great point. Folks coming to your microphones, including myself, will bemoan all day missing the jobs report. It's not something that regular people are really keyed into. I think it has a lot more to do with the things that affect people's everyday lives. Okay, so travel is huge. And I've seen shutdowns end the afternoon of the morning that the air traffic controller said, that's it. We're just not going to keep coming to work without pay. Now, that can take 4 weeks. It can take 5 weeks. but that is what happened in one of the more recent shutdowns. Same with, of course, TSA workers. People are very sensitive to those kinds of lines. Then you have services that people want to access, whether it's getting your passport in a timely way, whether it's calling the Social Security Administration. We should be very clear, of course, Social Security checks go out, and they'll continue to go out. The workers that send those out are so-called exempt or essential workers, or exempt from the furloughs. But if you try to call somebody and get them on the phone, it's hard anyway. It's particularly hard now. So I think it's those kinds of, you might think of them as almost harassment just in getting through your daily lives factors that can lead to a level of frustration that eventually forces Congress to move.
I am curious, Jared, just about the politicking around this, particularly on the Democrats' side. I know that they have made this an issue about the Affordable Care Act and reinstating the provisions that they think should have never been stripped out to begin with out of those previous bills. But I'm also curious as to whether there is something underneath the surface here that goes a little bit deeper about trying to curb the power of the presidency, of Trump specifically.
Oh, that's unquestionable. And I don't even know if it's that far under the surface. I mean, you've heard Democrats explicitly argue that one of the motivations for the shutdown is that they can't even trust Republicans if there's a handshake, if there's agreement, because of all these rescissions and impoundments. The idea would be that you'd legislate a budget deal, but then the other side will refuse to spend the allocated funds. I think one way in which Democrats are operating is that this may not prove to be the ultimately successful legislative strategy. They may not end up getting exactly what they want. That's typically the case in shutdowns. But it's also a very important messaging strategy for them. They have the microphone. They have a little bit of leverage here because of the filibuster. And they're going to let people know the ways in which, A, they're being left out of politics, B, the ways in which Republicans are hurting them right where it hurts, in their affordability pockets, in their wallets and pocketbooks, and C, just very, very focused on the healthcare dimension of all that.
Do you think that that's going to resonate, though, with the American people? I mean, we've seen the spin by the Republicans, and they've been relentless and, more importantly, united in that messaging so far. And I am curious as to how rank-and-file voters actually view what's going on in Washington.
Well, that's why we now have pollsters who are literally taking daily polls of this stuff. So that question is very much a temperature question. You have to take the temperature every day, see where the public is. Thus far, I've actually been surprised about how disciplined the Democrats are. They're not exactly known for being a disciplined group these days, but they've been staying very much on message. And I've seen numbers north of 70% in terms of people who are moved by the Democratic message that Republicans are hurting them when it comes to health care affordability. This certainly came up during the Budget Debate Act, but the fact that 77% of folks on the ACA exchanges are in red states, that hasn't been lost on folks in the debate. And the fact that Republicans, of course, control all three branches of government, four if you want to include the conservatives on the Supreme Court. And so thus far, Democrats have been prevailing. I have a sense that that's pretty elastic. It could change perhaps quickly, but that is the temperature-taking exercise these days.
All right, Jared, really appreciate you joining us today. Jared Bernstein there, former chair of the Council of Economic Advisers and a senior fellow at the Center for American Progress. Day 6 here of the government shutdown, and a lot of questions, I guess, about what could end it, and more importantly, why we even got here in the first place. Gautam Mukunda joins us right now. He's a lecturer of management practice at the Yale School of Management. He's also a Bloomberg opinion columnist. Gautam, great to see you here. I kind of want to start with kind of what ends these shutdowns, because I was kind of going back to history, and it's all over the map. You had some where you had kind of bipartisan agreements. Then you had some where it was basically, judges and courts got involved that ended the shutdown. And then, of course, remember the last long one that Trump was shepherded back in 2018, 2019. That happened to coincide with an election, a congressional election, where the Democrats won power in the House, and they kind of forced his hand.
Yeah, so usually someone folds. I mean, that's the easiest answer is someone folds. Sometimes the pressure becomes so hot that they find some kind of a compromise. And so usually the party that folds is the party of Congress, because it's just really, really hard to compete against the presidency in a modern media environment. The president just towers over everyone else. I'm not sure how that's how this one's going to work out, though.
Yeah, and I am curious too. I mean, we were kind of talking in the newsroom about kind of the origins of all this. A lot of people seem to forget. I know we go back to 1976, but most of these shutdowns really started in the 80s under Reagan. I think it was Benjamin Civiletti, the U.S. Attorney General, who kind of established this idea that the government basically could shut down in these types of situations. Without that legal precedent, do you think there would have been more options to keep the government functioning, even if there was some sort of partial shutdown?
Yeah, and what we saw, right, was attempts by various parties, things like that, to create like sort of paper shutdowns where the government kind of kept operating, even though the budgets weren't approved, things like that. And so what I do think is this shutdown is actually different than the previous ones, and it is because of the Supreme Court. The Supreme Court essentially created this shutdown because they created, by the way they're using the emergency docket, they essentially gave Trump the power to do these rescissions, which no one thought the president had before. And it made it, from the Democrats' perspective, it made it impossible to strike a deal because there's not an interlocutor they can trust to keep the deal because the Trump people are not, they're not legally obligated to keep to it after they make it. And in that circumstance, it's really hard to strike a deal with someone who can just turn around and violate it 30 seconds later.
Right. Well, that's what I was going to ask. So this shutdown is different, like you say, in that the Supreme Court created it. So how does that affect how it is possibly going to end, especially what you're speaking to about mistrust as to whether those deals will be honored?
Yeah, so the political dynamic here is a little different, right? So as Jared Bernstein said earlier, it's clear from the polling data that the plurality of Americans are sort of saying this is Trump and the Republicans' fault. But the dynamics are very strange, right? So on the Republican side, all of the threats that they're making to put pressure on the Democrats, like they do put pressure on the Democrats, but they're also things that are deeply unpopular, right? Like going off and killing sort of green construction, or we're going to lay off hundreds of thousands of government employees. There is, to first order, almost no public support for things like that.
Yeah.
And so there's this sort of bizarre thing of, and actually, let me add to that. And then what the Democrats are arguing for is we need an extension of the Obamacare subsidies. These subsidies are massively popular, right? If they go away and premiums shoot up, it will be politically devastating for Republicans, particularly in red states. So this is a really strange dynamic. Democrats are demanding the right to save Republicans from their own political mistake. And Republicans are saying no.
So square that circle, put that into context with some of the notes that you passed over to our producers that Democrats are misplaying their hand. Are you speaking just to that dynamic where it seems like they're kind of trying to help Republicans out, or are they not playing the cards that they have in a way that might be advantageous to them?
So I realized after I sent it to you that there was a better way to phrase it.
Yeah.
Democrats are playing the wrong game, right? So the game that they are playing is one about policy. They think, well, if we get these subsidies extended, that will be good for people, and that's our job. And they also believe, I'm sure, that if it will be good for people, we will be getting political rewards for it. That is the way American politics used to work, or at least how we used to think it worked. But, the Trump administration just passed a gigantic bill, the one big beautiful bill, right, that was massively unpopular and really hurt their own voters. And their belief was that they would not be punished for this by their own voters. And judging by the popularity of Trump within Republican circles, that belief is true, right? So Democrats are acting like political outcomes are driven by policy. And I just don't think that's true anymore. There's a real generational shift here, right? Yeah. If they win and get these subsidies extended and the premiums don't go up, I don't think there will be 20 people in the United States who vote for Democrats because of that.
But on that point about the Democrats, and I'm paraphrasing you, not getting it in the way that the Republicans did, but we saw this long burn with the Republicans where you saw the establishment Republicans, they were very resistant to some of these far-right newcomers. Many of them were younger, who just looked at policymaking and politicking as much different things. I feel like you're seeing the same tensions on the Democratic Party side, although not necessarily with the same results. And I'm curious if you do see the party eventually shifting there one way or the other.
So I think it's inevitable that it will because, valuing policy over politics is good for the country, but bad for the party. And what we see in every competitive market, right, is over time, if you do things that are good for yourself, you will push out the people who are sort of interested in systemically, absent big, larger external forces. So you could imagine, here's what would change it. If one of the two parties wins by some gargantuan margin, I mean 1932 style or 1980, the election cycle, where they're like, we're going to be in power for the next 3 election cycles.
Yeah.
Then the incentives shift And people will be saying, well, we need to govern. Because whether or not, if we govern successfully is actually what will determine what will happen. But as long as power is decided by five seats in Missouri and Nebraska, this is going to keep happening.
And a 1932 style landslide. I feel like in this political climate, that's not going to happen. I'd also like to point out, I had an interesting conversation with somebody this week, and a very smart person, and asked him about the government shutdown. He literally said, the government shutdown? So there you go. That's what we're dealing with as well. Gautam, great to have you as always. Gautam Mukunda, lecturer of management practice at the Yale School of Management, also an opinion columnist for us here at Bloomberg. Katie?
Now coming up, massive moves in chipmaker AMD on the heels of a new deal with OpenAI. We discussed with Brad Lightcap. He is the COO of OpenAI next. This is The Close on Bloomberg.
All right, well, we started today with a big pop in shares of AMD. This after it inked a landmark deal with OpenAI to build out infrastructure, giving the chip maker a chance to challenge NVIDIA in the computing industry. Now, this comes on the same day as OpenAI's annual Developers Day, a Developers Day where we've seen a lot of stocks, including Figma, HubSpot, Cisco, Mattel, just to name a few, also moving significantly based on some of the comments coming out of that conference. Joining us right now is Ed Ludlow. He is at that conference, and he's joined right now by the COO of OpenAI, Brad Lightcap. Ed?
Yeah, and the headline is the ability to use third-party apps within ChatGPT. And the profound impact on the market was simply those name-checked saw their stocks move in a significant way. Delighted to speak once again with Brad Lightcap. It's as simple as that, really. You know, the ability to be within ChatGPT and access Spotify or Figma as two examples. When you were discussing the idea of that and API access with those partners, was it a tough negotiation to get them on board with the idea?
No, I mean, we've seen enthusiasm for this from the beginning. You remember way back when we launched something called plugins, back in the early days of ChatGPT. This was one of our first attempts to start to build an ecosystem around ChatGPT so that ChatGPT can start to engage with and interact with the applications that are important to you in your personal life and at work. And now we really have a much richer surface through MCP and other protocols to be able to bring applications into ChatGPT and for really to allow you to engage with ChatGPT in the kind of work around work, right? It's the contextual aspect of I'm doing X or I need Y, I'm on a road trip and I want to know what playlist would go well with this in the context of my broader trip planning that allows you now to kind of use ChatGPT to solve that higher level task and then also integrate apps contextually to solve those specific problems.
We're in a place where ChatGPT has become more of an operating system, whether that was your ambition or not. Is that where you want to take it? To be an OS and a developer driven platform? It's almost like an app store, you know, on paper based on what you announced this afternoon.
Well, we've always thought of ChatGPT as like a super assistant. We never set out to build a chatbot. We always wanted to build something that was really true to you and what your preferences are, what your goals are, that could actually help you achieve more. And so I think part of that is ChatGPT having an appreciation and understanding of the applications in your life that are important. And I think enabling that kind of connectivity and interoperability makes ChatGPT richer, also enables a lot of pass-through for people to be able to engage with apps they love as well as new apps.
The pass-through bit is interesting. Were there concerns with some of those technology companies you're partnering with that it would take traffic away from their own domains?
No, I think mostly people are really focused on building into new interfaces, right? This is just like mobile in some sense, where you have a new interface, you have a new form factor. People are going to want to use mobile form factors on the go. And apps like Spotify in some ways exist almost because they really nail mobile. And so we think actually there's an opportunity for builders to create entirely new applications that are even native to ChatGPT. And of course for services you love to be able to benefit there too.
Is there a revenue sharing agreement with those third parties whose apps are accessible through ChatGPT?
So we're going to figure out the economics of this over time. This, you know, we're brand new here. Plugins was the first version of this, and that was even an experiment. And so, like everything at OpenAI, we take this very experimental mindset to making sure we get it right. But the idea is we do want to build something that's useful for developers, and of course, there's going to be have to be some exchange in there of economics and value, and we'll have to figure out how to get that right.
You have hit 800 million active weekly users. You announced on stage. Actually, Greg Brockman told me that at 8 o'clock this morning, and maybe we missed it, but it's a significant milestone. All the time I'm asked by all kinds of people, do we have any sense of within that 800 million, how many are base level free users and how many are premium level paid subscribers?
Yeah, we have a very healthy funnel of people that choose to pay for ChatGPT. It's surpassed where my expectations, frankly, were. People have this kind of conception that consumers tend to not pay for software. Similar even to what I was saying before around how do you co-develop the product alongside the business model. ChatGPT is a great example of that, where the subscription model, I think, has been really a testament to how valuable it is for more users than I think we expected to be willing to pay for it. So we don't, I think, disclose the exact number, but it's a healthy amount and more every day.
OpenAI in the beginning went after the consumer for users aggressively. You are now very focused on the enterprise business. What is the strategy for that, and how do you prioritize your enterprise business?
Yeah, glad you asked about that. So really today's announcements actually, I think, target what are an important set of use cases for the enterprise, things we've been hearing enterprises ask us about now for some time. So specifically one is we now have an ability for enterprises to build agents in a much more visual, much more intuitive way. You've heard us say 2025 has been the year of agents. We think that's true. Codex has been a great example for us of that. Our coding agent now available through an API also.
The lead time to make software is a lot shorter.
It's gotten a lot shorter. I think you saw today we live demoed, I think 3 or 4 different things that we've built in real time. We expect that to continue to be the trend. Things like Agent Builder allow enterprises to be able to build agentic experiences, powerful agentic experiences on the go, iteratively, and connect it into the tools and sources of information that matter for the business.
The data point that jumped out at me is your API is handling more than 6 billion tokens per minute, and that helps explain why the AMD deal, which is focused on inference. You are involved in all of these domains of the company. I've already asked Greg, but I've got to ask you, how are you going to finance yet another infrastructure project? Like, is there going to be some debt here specifically for the AMD capacity? And how do you move quickly to get it online?
Yeah, well, the high level thing is we are tremendously compute constrained. It feels like we're in this kind of recurring theme of being compute constrained. And I think the reason for that is the answer to the question you asked, which is demand.
Right.
We see there are multiples of demand that are latent and untapped. From what we have today, and even today, obviously, by any standard, demand and revenue growth has been torrid in its pace, and so really we have to invest ahead of that. And I think that's going to be the rate limiter for us to be able to go capture demand, whether it's consumer or enterprise, and for us to be able to build new models, parallelize more experiences, more product experiences, and then enable users specifically to be able to use those products more actively in their daily life, at work, and at home. And so. Even things like Sora, the app we just launched, we wish we could invite more people onto it now, but we just need more compute. So the AMD deal, we're excited about being, directionally a way for us to do that.
I've got to ask about the report that OpenAI closed secondary, or the ability for employees to sell shares at a $500 billion valuation. I already asked you this question, but what is the metric we're supposed to judge your success by? The $500 billion valuation, the 6 billion tokens per minute? To you, Brad, what is it?
For me, it's actually kind of a metric that we talked about is tokens. It's you mentioned 6 billion tokens per minute on our API. That is the purest, for me, the kind of essence of utility is that consumption metric. And so we've actively tracked that metric to see how people's consumption of AI is growing over time. And you see this happen in amazing ways. So things like Codex, for example, we've seen grow 10x since August, purely on consumption of tokens around coding. And you start to see that same pattern emerge across multiple lanes of use and across multiple areas of work. And that's the metric I look at, because if that number is going up, it means people are using us for more things, and that's the ultimate goal.
Brad Lightcap is OpenAI's COO. There has been a fire hose of headlines, and it has moved markets all day long. Back to you.
All right, our thanks to Bloomberg's Ed Ludlow and OpenAI COO Brad Lightcap at the company's annual Developers Day. Of course, during that conversation, news breaking.
Yeah, let's get right to it. AppLovin, those shares down almost 20% right now. Remember, this was kind of the darling. The shares had almost doubled just in the past 3 months. It just got added to the S&P 500 last month. We're now learning, based on Bloomberg reporting, that the Securities and Exchange Commission is actually probing the company's data collection practices. This specifically relates to allegations that the company violated platform partners' service agreements to push more targeted advertising to customers. Now, this is according to people familiar with the matter that Bloomberg reporters have spoken to. We should point out that those reporters have also reached out to AppLovin. For right now, that company has declined to comment.
And like you said, this has been a darling in the stock market. You can see the reaction right now. According to reporting, this is in response to a whistleblower complaint filed earlier this year, as well as multiple short seller reports that have been published in the past several months. So a lot of scrutiny coming in on this company. Yeah,
we're going to try to get some more details on this. Obviously a fast-moving story, but when we talk about just this burgeoning AI and broader AI trade out there, which AppLovin to a certain extent got caught up in, there have been a lot of questions here about the durability of that, not so much because of the allegations here, but just overall whether we're actually, I guess, on firm footing, if you will.
Yeah, absolutely. So we'll see how this story shakes out. Hope to get more details on it. But again, the reaction in the shares, you can see a big wipeout underway. Yeah, absolutely. Overall, though, the market's still holding up, at least the broader market, with the S&P higher on the day, as is the Nasdaq and most of the other major indices. Seema Shah joins us right now to count us down to the closing bell, Chief Global Strategist at Principal Asset Management. And Seema, I do want to start off with the AI trade writ large, because we've seen it get goosed a lot over the past few days and weeks with these announcements by OpenAI and some of the other big players in this space about that continuing spend that we're seeing out of major companies. The idea now that, at least for the U.S. economy, it's corporate CapEx spend outpacing consumer spending, the first time we've seen that in decades.
Hi, Romain. Thanks for having me. Yeah, I think, increasingly, as you said, as we've seen these numbers coming out, these reports, it's increasingly difficult to kind of try to separate the AI theme, which we know has been really leading and driving markets for the last few years. But it actually seems like it's having that layoff impact into the macro scenario as well. So, there's benefits. We can see that CapEx drive has been driving the economy, even as other segments maybe have been weakening. But we also have to think about some of the risks that over time, if you were to get a setback in some of these numbers, what does it play through to the broader economic picture?
Are you concerned at all, Seema, about what some people have deemed the kind of circular nature of some of these deals? The idea that, OpenAI enters this agreement for AMD to basically use OpenAI service, OpenAI to buy AMD GPUs. It's this idea that this is kind of this closed ecosystem right now of deals. Is that cause for concern?
I don't know if it's necessarily cause for concern at the moment, but I think it definitely needs some scrutiny. And I think what we're seeing over time now is that economists and strategists are really starting to take a closer eye. As I said, we've all known about the kind of the general market side of it, but then trying to dissect what the general macro repercussions, what the risks are, is going to be really key. I think the one thing that we are saying, though, is, if there were to be a real setback in some of these CapEx numbers, and as you said, the feed through to so many other companies, the circularity of that could have some very significant ramifications for the US economy, for the global economy, if it were to fall apart. I have to say, though, that even if you were to get a disappointing number, overall, we do think that the AI narrative is likely to continue. It just could be a bit of a setback with some broader repercussions, but again, something that we think hopefully would be fairly short-lived.
And I mean, just thinking more broadly about these deals that are getting signed, Romain brings up this circular nature that some have pointed out about all of these big companies just spending money on each other. I think back to the Oracle OpenAI deal that was from the week before or the week before that. And Doug O'Loughlin pointed out in Fabricated Knowledge that there's no way for Oracle to pay for this with cash flow, that you're seeing these companies have to start to raise equity or debt in order to fund their ambitions when it comes to the AI infrastructure space. And I wonder, Seema, how that changes the nature of investing in the tech sector. A lot of these big tech mega cap names are known for having relatively clean and strong balance sheets. But now, when it comes to trying to compete and having to keep up in this race to just spend money, it seems like sort of the nature of those companies could change when it comes to their relationship with debt.
Yeah, Katie, I think that's absolutely right. When we've been talking about tech up to this point, and there's always concerns being raised about valuations. And I think the thing that people keep coming back to is that these are very cash-rich businesses, very, very strong balance sheets, and their growth has been really driven by fundamental strength drivers behind them. Once you get into this new wave where so much has to be funded by debt or equity, well, then the equation starts to change, and you may see some investors feeling a little bit more skeptical about the sustainability of this. How frothy is this? So I think some question marks being raised around valuations is likely going forward, and so it does, of course, become more and more important that these companies need to continue delivering on some of the stuff that they've promised. Of course, each quarter it feels like it gets more and more difficult for them to actually deliver.
And Seema, I'd love to get your thoughts on a dynamic that is very clear in today's stock market. You have OpenAI really driving news when it comes to a lot of public companies. OpenAI is a private company, but then you think about what we're seeing in AMD and a whole wave of other companies. As an investor, I mean, how do you make sense of that? That basically you have this company that you don't have quarterly updates on really being the chief catalyst for a lot of names in these indexes.
Yeah, there's so much on the concentration side of the market. As you said, these are private companies, so you're not necessarily getting the same kind of numbers or information, and that's still driving the strength of the market, and of course, and it's driving the strength of other companies, which are not necessarily directly related. So this is something we need to keep an eye on. I think that's been the story all along. Is essentially the concentration of these companies really requires closer and closer scrutiny. And then when you start to think about the macro impact, which is becoming increasingly clear to investors, the closer the look, it's going to be the more important it is.
Seema, always great stuff. Seema Shah, Chief Global Strategist at Principal Asset Management, counting us down to the closing bells. Just about 2 minutes to go here with the S&P sitting at record highs, the Nasdaq sitting at record highs. So too is the Russell, the Dow sitting this one out. A full breakdown of all of today's market action and what comes next starts with our global simulcast right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell with a global simulcast. We're joined now by Carol Massar and Tim Stenovic, both in the radio booth, as we welcome our audiences across all of our platforms, including our partnership with YouTube, to parse the most crucial moments of the day. And Carol, nothing is more crucial right now than the news that just crossed the wire. The Charlie XCX is back in the studio.
Oh, I thought you were going to go to App Levin, but no, that's not where you went, because I know that stock is under some pressure. We'll have to come back to that. I am, though, looking at the semiconductor space overall, thanks to AMD and the OpenAI deal.
Does Carol know who that is? Or no?
Yeah, I know who. Yeah, we know Charlie.
Oh, okay.
That hurt.
She's in a feud with Taylor Swift. Come on.
I know she is, but everybody is at one time or another.
Let's not forget the collaboration that came out about a year ago.
Wow.
Charlie XCX and Bon Iver.
Okay.
Okay.
Oh,
Thanks
little
for
flex
pronouncing it.
over
All right.
here.
He's a huge
Highly
Bon Iver
recommend.
fan.
Highly recommend
Hey,
checking
Tim,
that one out.
Thanks for the mansplaining. Really
I
appreciate it.
didn't mansplain at all.
Felt like mansplaining to me.
Okay. Can you guys do this?
Semiconductor stocks up 3%. Thank you so much, AMD. I mean, that one's up 23% alone. Take it away, guys.
Oh, or we're taking it away?
You got to help me out here.
I thought we were still talking about
scarred.
what's going on. Hey, look, I mean, in all seriousness, so we talk about a market at record highs, but more importantly, why it's at record highs. OpenAI makes another big announcement, this involving AMD. They hold a developers conference. They mention Figma, they mentioned HubSpot, they mentioned all these third-party app developers, and you see a big rally there. That is the trade, and at least for the last few days, and quite frankly, the last few weeks, it seems to be the only trade in town. A big part of the reason why you see the Dow Jones Industrial Average in the red here on the day, while you see the S&P 500 in the green at a record high, up about 25 points or 0.4%. The Dow down 64 points or about 0.1%. The Nasdaq Composite and Nasdaq 100 each up about 7 to 0.8% on the day. Record highs around the horn there. And look at the Russell 2000 holding its gains from last week up 10 points, 0.4%, a fresh record high.
I love when you say looky-loo. All right, let's get to the S&P 500. Folks, it's up 7 days in a row, as Romaine was pointing out. It's up about 2% in those 7 days. Katie, if I look at the trade, though, you had about half higher, half lower. So it's not like everybody was enjoying the move up to another record close on the S&P 500.
It was slightly better if you take a look at it through the lens through sectors. You had 7 sectors in the green, just 4 in the red. What was leading the charge? Who other than information technology, up about 0.6% as a whole. Consumer discretionary also punching above its weight. So too did communication services.
Technology?
I don't know. I always feel like I'm saying its formal name, its government name. That's just what the terminal tells
Just call it IT.
IT. Yeah, there you go.
That feels so outdated. It's like communication services. What's
that? I couldn't tell you. But tech, information tech leading gains there. I will just point out healthcare having a bad day. It's been an interesting sector as of late, but right now interesting to the downside.
Healthcare. Now that's a name that's timeless, right?
Oh yeah, I know exactly what that is.
We don't just call that HC. We have to call it healthcare. All right, let's go to some of the individual gainers. I mentioned semiconductor outperformance, the stocks outperforming. Thank you, AMD. We know the story. You guys have spent a lot of time talking about it. It's been really our big business story here on this Monday. AMD shares up as much as 37% at their highs today, finishing with a gain of just shy of 24%. I mean, holy moly, Batman, the AI rally and the chip grab, it is on in a big way. We've spent a lot of time just trying to figure out the spend, the companies that are working together. I mean, does it all play out? Will the revenues ultimately be there? And I feel like, I guess time will tell. But anyway, AMD, top gainer in the S&P and NDX. That deal with OpenAI for AI infrastructure could generate tens of billions of dollars in new revenue.
Back a lot of memories, like when I would get off school as a kid and you watch the old reruns of like the original
Holy
Batman,
moly, right?
Burt Ward and Adam West.
I know. It was iconic, right?
It was, absolutely.
Right. Good stuff, good stuff.
Great memories.
Tim and Katie have no idea.
Yeah, they're like, who, what, where?
I'm reminiscing.
All right, let's get to another big gainer in today's session. I don't know if you guys checked out critical metals today. Ticker CRML at its highs, up 109%, finishing with a gain of 45%. This after Reuters reported the Trump administration officials have discussed taking a stake in the metal mining company. If finalized, deal would give the U.S. government a direct investment in the largest rare earths project in Greenland, again, according to the Reuters report. So again, this is a theme we've seen about the U.S. government taking potentially ownership stakes in various companies that they deem important to U.S. security. And then Comerica, we had a big bank deal. Let's not forget that. Fifth Third Bancorp agreeing to buy Comerica for about $10.9 billion in stock. It would be the largest U.S. bank deal this year. We've seen several bank deals happening. And again, Comerica, Tim, up about 14% in today's session.
All right, well, let's talk about some notable decliners in the S&P 500 today. Among the worst performers on a percentage basis was Verizon, ticker VZ. Actually, shares closing the worst one-day drop, I should say, going back to April of this year. So some surprise news from the C-suite. Hans Vestberg out after 8 years as CEO since 2018. So 7 years as CEO. Former PayPal CEO Dan Schulman coming in as CEO, replacing Hans Vestberg. Vestberg will stick in the role of advisor to the company for the next year. He's going to help ensure a smooth transition, including the integration with Frontier Communications. That purchase went through of late. Verizon has been losing subscribers and market share. It did shed 51,000 monthly mobile customers in the second quarter. Schulman, actually, he's known for eBay and PayPal, but he also had experience at AT&T, Virgin Mobile, like more than 20 years ago. He was the founder of that company, and he was there for 10 years. And then he was at Nextel Sprint. So he's got some experience in the communications space. Once again, shares down 5.1%.
That's called street cred.
Street cred. I always thought of him as a Silicon Valley guy. That's kind of like when he got on my radar, and a payments guy. But so it's interesting that this is, and he's been on the board for years too. Fifth Third Bank finishing down 1.4%. Carol talked about the increase in Comerica's session today. Fifth Third, the acquirer, shedding 1.4% today. This after it announced a deal for about $10.9 billion in stock. It is the largest U.S. bank deal this year. We're going to be speaking with Herman Chan about this in just a few minutes. And then a late-breaking edition.
Spoke with him.
You did. I saw him on your air.
It was really good.
Was it good?
Yeah.
Thanks for warming him up for us.
We did sort of like a whole hour on AMD, OpenAI, everything happening with sort of the NVIDIA and the AI trade today. Yeah. It was a lot.
Yeah, we almost did too.
You almost did. Not quite. This was a late edition. Levin shares falling 14%. They cratered right at 3:41 p.m. Wall Street time today. This was after Bloomberg News reported that the SEC has been probing Levin's data collection practices, specifically allegations that the company violated platform partners' service agreements to push more targeted advertising to consumers. Levin declined to comment on the probe, saying it regularly engages with regulators and would disclose any material developments through public channels. The SEC didn't comment due to a shutdown.
All right, just real quickly, let's take a look at yields. We're going to look at Treasury yields here in the U.S. You did see them move higher across the curve, with the longer end of the curve seeing the most action. But we should point out, this was actually a global phenomenon. Remember, we had a lot of developments over the weekend, including the extension of that government shutdown here in the U.S., a government in France that lasted, less than the lifespan of a mayfly. And then, of course, you have potentially a new prime minister in Japan that is expected to also put some downward pressure on bond prices over there here. So globally, you saw a little bit of a sell-off when it comes to sovereign debt.
All right. Well, with so much uncertainty about global governments, it's good to know that there's something we can really count on, and that has to do with Taylor Swift, right?
Good.
She can sell stuff.
She can sell
way.
things.
She can, right? So we had her album, The Life of a Showgirl. It sold 2.7 million copies in the United States on its first day. So it's kind of amazing. It broke a record. But it's not just that. People actually went to theaters to see Taylor.
Yeah, listening party, the highest grossing picture.
Huh?
That's ridiculous. Who would do that?
A few of our producers, at least.
Did you guys do that?
No.
Okay.
No.
The official release party took in $34.1 million in ticket sales in the U.S. and Canada, another $16 million internationally. An AMC exclusive. It's a second Swift picture released by AMC. Adam Aron, the company's CEO, we've spoken to him in the past. I didn't realize this until I read this story by Thomas Buckley. He's close friends with Taylor Swift's parents.
Yes.
I didn't realize that.
Yeah. I remember reading a whole story about that back in the day.
Yeah.
Well, I did not make it out to the Taylor Swift extravaganza this weekend. I was too busy preparing for earnings. We're expecting earnings out of Constellation Brands, of course, a big maker of beer. Modelo, your favorite, Tim. Modelo Light, excuse me.
Okay.
But, there's been a bigger story here. This idea that we're not drinking as much, and now there's a lot of concern right now that some of the retaliatory actions by people overseas who are upset with our trade policies here aren't buying U.S. products, basically U.S. whiskey.
We actually have some numbers here. Exports of U.S. liquors, including bourbon, fell 9% from a year earlier, with shipments to Canada plunging 85% to less than 10 million in the period. It is pretty amazing. I mean,
so what are they drinking up there in Canada?
Maybe their own home brew, but it would speak to sort of that retaliatory feeling. I remember, when we were discussing the first round of Canada tariff talks, that was definitely a major theme there.
Yeah, it kind of makes sense, right? If, amid this tariff war and the pushback by the U.S., right, they're going to fight back with, just not buying our stuff.
Yeah. All right. Well, some of us will pick up the slack.
Not Tim.
I was told not to talk. I was told we're done. Unlike some other people, I actually listened to Finley, our producer.
That's good of you.
All right, Finley, we're going to listen to you. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romaine continuing there on The Close on BTV, and Tim and I continuing on Bloomberg Business Week Daily right here on YouTube and on radio. We'll see you again, same time, same place tomorrow.
And we continue our coverage here on Bloomberg Television with a closer look at sovereign debt and a new report out by the IMF on what's going on in emerging markets. A deeper discussion with Tobias, Adrian, financial counselor and director of the Monetary and Capital Markets Department over at the IMF. That's coming up next here on The Close. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. We start the week off on a high note for U.S. equities, a record high for the Nasdaq, a record high for the Russell 2000, and a record high for the S&P 500, 6740 and change, powered by that news that we just got earlier today out of OpenAI. A record day for gold as well, as there is still a flight to safe haven status. A record day for Bitcoin as well, or a record weekend, I should say, for Bitcoin as well. Once again, maybe part of that debasement trade and sort of a search for safe havens. Not necessarily so when it comes to currencies and when it comes to treasuries. You're taking a look right now at dollar yen down, weakening by about 2% on the day.
Well, let's go from currencies to what we're seeing in the stock market right now. A quick roundup of where we ended the day. AMD, the star of the show, up nearly 24% after inking that deal with OpenAI, sending a whole bunch of shares moving, including the likes of NVIDIA. Maybe AMD stepping up as a worthy competitor here in partnership with OpenAI. NVIDIA shares down about 1%. And then we had that late breaking news from Levin. Bloomberg reporting that it's being probed by the SEC over its data collection practices. You can see shares ending the day 14% lower. But let's get now to our top story, and that is global politics and sovereign debt markets. You had yields on 10-year French bonds jumping after the prime minister's surprise resignation, throwing France into another political crisis. Meanwhile, traders are also keeping an eye on U.S.-Argentina talks, with the country's finance minister currently in Washington to negotiate the terms of a U.S. aid package. Remains certainly a lot to keep an eye on.
Absolutely. And who better to talk about it with than Tobias Adrian, financial counselor and director of the Monetary and Capital Markets Department over at the International Monetary Fund. Great to have you here. I do want to start off first on just issuance that we've seen this year when it comes to emerging markets. And a lot less of that was dollar issuance, if my data is correct.
So we have seen both hard currencies, so dollar issuance, other hard currency issuance, as well as local currency debt issuance. It's not a record year, but it's a very solid year to date.
Why are we seeing more local currency issuance?
So emerging markets, particularly the major emerging markets, have really worked on developing their local markets. They realized that that can be a shock absorber for various shocks, either from abroad or domestically, and a lot of progress has been made there.
And what does demand look like on the investor side of things? When you think about sort of the shift here between hard and local currencies, I mean, how has that been received by the investment community?
Yeah, so what major emerging markets has done is to really develop a buy side in their own country. So what you're seeing nowadays is a mix of global investors together with local investors. And what we're finding is that, you know, having those local investors alongside the global investors is really stabilizing the country.
And why are we seeing that local investor base get built up here?
So this is really policy work in the countries. So the countries are developing insurance companies and pension funds. And so you have a rich trading environment. There are primary dealers, there are repo markets. All of these things that we are used to in advanced economies like the US is happening more and more in major emerging markets, and it's really benefiting them.
What do the economic fundamentals look like, particularly in light of some of the fractures that we've seen in global trade and or the traditional relationships in global trade?
Absolutely. I mean, look at emerging market stock indices, right? Mm-hmm. We have seen a rally in EM stocks. Mm-hmm. You know, they're up, you know, about 25% year to date. That's nearly twice as much as advanced economies. Mm-hmm. So that's you know, really telling you where the market is assessing those countries.
One issue that we've dealt with a lot over the years when it comes to people investing in emerging markets is the idea that when you start to see a country sort of start to get back on its feet, get its fiscal house in order, sometimes those changes end up being temporary. Either there's some sort of political upheaval that ushers them out. We're kind of seeing this play out now in Argentina, which, you know, it seemed like 6 months ago we were all praising some of the measures that they were taking, and now, you know, we're talking about potential bailouts by the United States.
Well, I don't want to comment on a particular country in this interview, but, you know, basically, you know, countries have been able to make the right choices, and that is helping them in terms of stability and growth trajectory. But of course, we have also seen countries making other choices. So it's really about having robust policy frameworks in place.
I know you don't want to comment on a specific country, but it's hard to not talk about what's going on in France. And you just think about political turmoil overall, how it's affecting certain countries, certain credits here. And I wonder, I mean, you take a look at the developed markets in contrast to the emerging markets and some of the success stories you have here. And I wonder what the balance looks like from where you're sitting.
Yeah, so what I would say is that, you know, when we look at the global debt picture, you know, debt has been rising everywhere. And that's true in advanced economies, and that's true in emerging markets. So we are in a world today compared to 5 or 10 or 15 years ago, where debt levels, sovereign debt levels, are that much higher. And that makes markets more sensitive and more fragile relative to any political news, may it be on the good side or the bad side.
And we talk about these rising debt levels, and I just always come back to the investor base. We already talked about how you're having a local investor community really get built up here, revitalized. Has that been at the expense of global investors coming into emerging markets, or what's going on with that community?
I wouldn't put it as a either or. Rather, better market liquidity is benefiting everybody. And so having a better domestic investor base is increasing market liquidity domestically, which is also benefiting global investors.
I do have to ask you just about the general role right now of the IMF in sort of facilitating some of those policy changes and, more importantly, I guess, providing support for those policy changes. Is it still effective?
Oh, absolutely. We're working with all our 191 member countries to strengthen policy frameworks. In some countries, that's hands-on technical assistance, where we really try to help countries build more resilient and stronger and better governed institutions. In other countries, it's through surveillance, and in some countries, it's through programs. So, we're there to help the membership.
All right. I really appreciate you being here with us today. Tobias, Adrian, financial counselor and director of the Monetary and Capital Markets Department over at the IMF, a focus in on sovereign bonds. When we come back, though, we're going to turn back to the equity markets. And Constellation Brands, Katie Greifeld, I know you're a big Modelo fan, just reporting earnings up about 3% here in the after-hours trade. And more importantly, it's kind of interesting. There's been a lot of talk how people aren't drinking. They've been hurting, but they're providing some guidance both on operating cash flow for the year and comparable EPS for the year, the high end of the range coming in above estimates.
Yeah, shares popping a little bit after hours, and what's been a pretty terrible year. We'll discuss what's ahead with Kearney partner Katherine coming up next. This is The Close on Bloomberg.
All right, welcome back. We're taking a look at shares of Constellation Brands, up about 3% in the after-hours trade. The company out with earnings for the most recent quarter here. Comp sales coming in at about $2.48 billion. That's slightly above the average of street estimates. We should point out, in terms of their guidance going forward, they are guiding slightly above what the street was looking for, though we should point out the company is still expecting to see contraction when it comes to sales of beer. And that's, of course, been a big question mark going forward as a lot of people look at some of the generational shifts in how we consume certain types of alcoholic beverages. Joining us right now to discuss the trends going on in the consumer space is Katherine, a partner at global management consultant Kearney, where she leads the food, drug, and mass market retail practice. Great to have you here.
Thank you.
I do want to ask, because I hear all these anecdotal numbers about Gen Z isn't drinking, and, Gen Z is responsible for everything, apparently, that's wrong in our society. But in all seriousness, this idea that, we're not consuming alcohol in the same quantities that we used to. We're maybe gravitating to either non-alcoholic or maybe, in states where it's legal, cannabis and other things. Are you seeing that show up in the data?
Yeah, we absolutely are. Yeah. We're seeing it in all the numbers. There's definitely been, even a few years ago when you saw really hot drinks like tequila or bourbon on the rise, or gin, those are even starting to moderate a bit. So we're definitely seeing that trend play out. And like you say, it is younger consumers. Older consumers still are drinking and driving growth.
And it's funny, too. There was a great reporting earlier today about how craft breweries are starting to shut down. They're really sort of feeling the pain. I guess my question is, when people are going out, what are they actually consuming? Is it just they're just spending more on food rather than drink, or are they drinking non-alcoholic stuff? What?
It's a mix of things, really. And you'll remember that we're seeing the CPI and dining out really going up faster than we're seeing it go up in grocery shopping, so food at home. So I think when consumers go out, they are being choosier, for one. And then there is this broader trend towards, you'll see on menus even, mocktails and low alcoholic drinks or non-alcoholic drinks. And so I think the consumer's really just being savvy, and it's a mix of things going on between that healthier choice and also savvier.
I will say it is amazing, though. Those mocktails cost almost as much as the real thing.
They do.
It doesn't feel great paying, $12 to $14 for a glass of juice. But I digress. I do want to talk a little bit more about the consumer, since we're in day 6 of the government shutdown, and it feels like we're all trying to parse out what the impact on the economy, on the consumer actually is. So when you take a look at the monolithic U.S. consumer that we talk about, Where does it actually start to make a difference, though?
Yeah, it's an interesting question because what we see is that it doesn't impact everybody directly in their paycheck. Only about 35% of consumers say, I think this could impact me directly or indirectly. But what it does impact across the board is consumer confidence. And so what we're seeing is consumer confidence being hit. We can look back at past government shutdowns and see that happening. And we're seeing that happen at a time when consumers were already really leaning into being savvy shoppers. And we're going into a holiday season. So it's an interesting time.
Well, set us up for that oncoming holiday season. It's October 6th. Soon we're going to be talking about Black Friday. And then, of course, the proper holidays after that. And if you have consumer confidence potentially weakening here, I mean, how does that all roll together?
Yeah, it's interesting. But before government shutdown, so in mid-September, we did some research with consumers. And what we found is even then, they were planning to shop earlier. They were planning to shop more online to save time. And they were planning to shop more savvily. They were going to use more coupons, deals. The big sale events were more important than ever to consumers. What we know from past government shutdowns that happened in early October, so if you look back to 2013, there was one that started October 1st, it ran for a couple weeks, and really what you saw was it shifted spending in that case back. So October was quite soft, picked up a bit more in November and December, but before that government shutdown, analysts expected retail sales for the holiday period to be 3 to 4%, and they ended up only being about 2%. So it definitely has an impact, even if it only lasts a couple of weeks, and that's because of that confidence issue, which really impacts everyone broadly.
How do you think retailers are preparing for this particular holiday season? Because even before the shutdown, there was a lot of concern about the health of the consumer, particularly in the middle and lower income levels.
That's exactly right. And I think retailers prepared in a few ways. One is they're managing their inventories very closely, although they still have a good bit of inventory because many bought ahead early and stocked up because of tariffs. They were also planning on big early sales. Like I said, this is like an ongoing trend that we're seeing where consumers are shopping early, and I think retailers are onto that. You know, we're starting big sale events starting tomorrow, and quite a few tomorrow, and Amazon Prime Day, Prime Days,
you're right.
Walmart Deal Days coming up this week, et cetera. And consumers really were planning to use that to start their holiday shopping. And quite a few consumers were planning to do the majority of their shopping during those events. I think that may moderate a bit. And so I can imagine that certain retailers that were expecting to gain big there are shifting their strategies for the end of the season.
I'm a little concerned. It's only early October, and apparently I'm already behind on my holiday shopping.
Yeah, you know, time marches ever on. Katherine, great to get some time with you. That is Katherine Black. She is a partner over at Kearney. And coming up on the close, a conversation with Citadel founder and CEO Ken Griffin. He'll be live from the Citadel Future of Global Markets Conference in New York. Don't go anywhere. This is The Close on Bloomberg. Let's get another check on these markets on this Monday. The S&P 500 and the Nasdaq closed today's session at records with a significant boost coming from chip makers and that AI trade. Joining us to discuss is Bloomberg's Jonathan Levin. Great to have you back with us, Jonathan. So that was the story, of course. AMD, OpenAI inking that deal. We've seen a raft of these sort of agreements made in the past couple weeks, the past couple months. I keep thinking about a snake eating itself in Ouroboros when you think about all of these companies spending money on each other in a circle, and I don't really know how that ends.
Yeah, exactly. I mean, at the end of the day, a lot of the folks investing in this technology are going to have to start making money. Otherwise, they're going to have to turn around and stop spending money elsewhere. And so, as you say, it is a little bit of a circle, and it is a little bit scary to acknowledge that when it ends for one party, when it ends for your snake, Katie, it's going to end for a lot of parties and maybe an entire stock market. So I think that that's a reasonable way to think about the risks going forward here.
Yeah, Jonathan, sorry. I just had to Google Ouroboros for a second here. All right, actually, Google search still works, believe it or not, sometimes. But it gets to this idea in all seriousness, Jonathan. We talk about a market, really, I mean, let's just go back. I mean, 3 years almost to the month. We had this sort of a public debut of ChatGPT. And to a big part of the rally that we've had over the last couple of years has been almost directly tied to that AI trade. If we do find out that it is Aurora Boreas in nature, and more so to a much broader degree than just a couple of companies, is that sort of cause for alarm, or can we sort of work our way through that and maybe see the trade broaden out?
Yeah, I mean, look, there are several ways this can play out. As I like to say, you know, even if you're utterly convinced that we're in a bubble, nobody can honestly tell you where and when it ends. I joke that it will probably end in Miami, but other than that, there's no telling exactly. I mean, look, it is broadening. The market performance is broadening out a little bit here. I think if you look under the hood at what's expected to happen in earnings here for Q3, we're expecting to see more of a contribution from things like industrials. But the big question is that just a sneaky AI trade too? When you see this, you know, this expansion of industrials multiples, when you see, when you see these earnings projections in that space, is that just a knock-on effect from the same doggone trade? And so how sort of over-correlated are these portfolios at this day and age? You know,
all right,
that's the concern.
Yeah, and we'll find out how all this ends. And of course, you'll be the first person we call when it does happen. Jonathan Levin, opinion columnist with us here at Bloomberg. Meanwhile, there's a big conference taking place here, being sponsored by Citadel. And our very own Francine Lacqua is to sit down right now with the founder and CEO of Citadel, Ken Griffin. Let's take a listen.
Rarely seen from an administration in years past. Secondly, the Trump administration is very much aligned with seeing the success of the American worker. So a number of the policies that are being effectuated really are about the average American family feeling that life is better and working better for them. This backdrop is fueling much of the enthusiasm that we see in markets in the United States. And then, of course, we're on a program of both fiscal and monetary stimulus that you would expect to see in the middle of a recession. We're seeing right here, right now, in a period of near full employment several years into the business cycle. So we're definitely on a bit of a sugar high in the U.S. economy right now.
So broadly, have markets moved away from the tariff issues?
The tariff issue is pretty much in the rearview mirror right now from the perspective of the market day in, day out. Now, the issues that relate to tariffs, in particular high inflation, are yet to be resolved. There's a sense of almost inevitability that the inflation genie is going to go back in the bottle. But I think that's a very premature conclusion. If you look at both the immigration policies, the fiscal policies, and monetary policies, it's a very pro-inflationary environment. And I think the markets are just way too calm about the prospects of a substantial move higher in inflation.
Is the Fed right to focus on the jobs, the labor market, instead of inflation?
So I think that is a really interesting debate. And I remember when Janet Yellen became the chair of the Fed, she had a very simple framework that she thought about. She thought about the fact that the U.S. had gone through one significant recession and the risk of another recession and the ensuing job loss and human capital atrophy that would go with a second adjacent or nearby recession would be incredibly damaging for millions of Americans. You lose your job twice in just a few years, you really do become separated from the broader employment market. And that was the lens through which she made a number of decisions to be in both at the time and in retrospect, reasonably dovish in terms of managing interest rate policy. Right here, right now, I think that argument is a bit hard to reach. And the Fed's trying to make a decision between buying some downside protection on the labor market and managing inflation. And I think they're making a decision that puts them at risk if we do see inflation reaccelerate early into 2026.
Is that what you're expecting, a reacceleration in inflation? And why has it not played out like many people thought that inflation would be higher?
I mean, we're still well above target, right? I mean, like let's just cut to the chase. inflation is substantially above target and substantially above target in all forecasts for next year. I mean, it's part of the reason the dollar's depreciated by about 10% in the first half of this year. It's the single biggest decline in the US dollar in 6 months in 50 years. Gold is at record highs. And the appreciation in other dollar substitutes, to use that word loosely, in items like crypto, for example, is unbelievable. So we're seeing substantial asset inflation away from the dollar as people are looking for ways to effectively de-dollarize or de-risk their portfolios vis-a-vis U.S. sovereign risk.
Are you really seeing that?
No, just check the price of gold.
Well,
I mean, I don't have to look very hard.
That's a life of its own. Yeah.
What?
It's a life of its own, gold.
No, but it's a life of its own as you see sovereigns around the world, as you see central banks around the world, as you see individual investors around the world go, you know what? I now view gold as a safe harbor asset in a way that the dollar used to be viewed. That's what's really concerning to me. And there's been plenty of published research in recent weeks, months, about foreign investors now, when they buy U.S. equities, hedging the returns back to their local currency. So that, again, is a bifurcation of I'm going to bet on American business, but I want to immunize some of my sovereign exposure to the United States.
Ken, the previous panel was talking about the shutdown. Given where we are in the shutdown, can the Fed properly do its job at the end of the month in these circumstances where we may not have enough data?
I don't think the data over a few weeks should really be that determinative to the Fed. I mean, that sort of overgrandizes what the impact or importance of that data is, particularly with the sampling errors that's intrinsic in how that data is produced and compiled for the Fed. Like, I just think that's a bit of a misplaced warrior concern.
Do you worry about the shutdown, full stop?
Look, the shutdown is symbolic of a different problem, which is the dysfunction between the Republican and Democratic Party on resolving issues with respect to the budget of the United States of America. And to be clear, both parties today are guilty of just profligate spending. You know, as I said at the start, the U.S. fiscal situation is that of a nation that's trying to work its way out of a recession, except the reality is we're multiple years into a very high period of growth. This is where we should be running a deficit of you know, in the Clinton days, we ran a surplus. At this point in the business cycle, we're now running a deficit of close to 6 to 7%, depending upon where a number of things land. That is just completely irresponsible. And so what's amazing is we're having a shutdown debate over, in the scheme of things, a relatively small amount of money, and neither party is stepping up to the plate to deal with or grapple with the reality that the United States needs to endure a fair amount of fiscal reform to be on a path for long-term sustainability.
Why is it not being talked about?
It's politically unpopular, and unfortunately politics have gotten shorter and shorter and shorter in horizon. You know, can you imagine that, like I said, in the Clinton days, they signed a budget with a surplus? And yet, that was in our lifetime. It's been a long time since we've seen that level of discipline in Washington around managing the affairs of the U.S. economy.
You worry a lot about debt, or you worry about debt. What's the way out?
Well, I mean, you must also, like, we all have to worry about the level of debt we have in the United States. And
the market is pretty cool about it.
The market will look past it for a few years, but if you go out with anybody to talk about what they worry about with respect to the U.S. economy, the fiscal situation is almost always top of list. So, you know, I think there's one thing to keep in mind, which is asset prices reflect a level of exuberance that we see today. But I got to tell you, if you're out with anybody who's in the asset management business, top of list concerns, the level of spending in Washington is always top 3, if not number 1 on the list.
What's the way out?
Well, the way out is we need, I mean, first and foremost, growth is an important part of the way out. And this is where the Trump administration focus on deregulation is so important. It's so important in terms of creating an environment in which growth can exist, like really important. Unleash the animal spirits in America. And the one thing about this country, different than most countries, is the entrepreneurial class in this country is incredibly ambitious and is really able to make profound changes happen. I mean, if you look across our investment portfolios, a substantial portion of all the money we invest is in businesses started in the last 50 years. I mean, it's remarkable the wealth created in this country by newly formed businesses. It's just stunning. It's the envy of the world. And the Trump administration is certainly taking steps to help encourage that continued American success story. But we also need to give real consideration to tax policy and to spending policies. And I think that how are they rebranding the big, beautiful bill at this point? Do you know what the rebranding is going to be yet?
How would you rebrand it?
Well, I mean, I don't think there's a nice way to put lipstick on that pig. I mean, it's a pro-cyclical tax cut late in the economic cycle. And you know, everybody in this room, like, let's be clear, no one wants to pay more in taxes. But if you're not on a sustainable set of tax policies in the best of times, what policies will that unleash in the worst of times? You know, for example, will the United States head towards a wealth tax when the inevitable bills come due? Will we head towards tax rates that we last saw in Europe, 60, 70, 80%, as the inevitable bills come due? Like, what is the long-term consequence of these policies right here, right now? And I think people are very concerned about what that might be in 10 or 15 or 20 years. How do inheritance taxes have to change in light of the tremendous amount of wealth held by the baby boomers and the tremendous amount of debt that their generation was a part of? So I think these are going to be really interesting policy debates that will emerge 7 years, 10 years, 15 years down the road, which could have some pretty adverse consequences. I mean, particularly for American entrepreneurialism. You know, today as an entrepreneur, you're like, if I build a great business, I will get to keep a substantial amount of wealth I create. If you go back to a world of 70% tax rates that we had in this country in this last century, maybe throw in a wealth tax for good measure, you may really impact that zeitgeist that is so powerful in terms of our economic prosperity.
Where do you see the animal spirits in the U.S.? Because a lot of chief executives say, look, they like some of the policies, but there are also a lot of policies. It could be visas or others, and because they're uncertain where the next one comes from, they're a little bit reluctant to spend right now.
Well, I mean, let's be clear. The Trump administration's been able to give us a lot that we love and a lot that we hate. Like, they're an equal opportunity giver. And on the pro side is clearly the push for deregulation, is clearly a message to American, whether it's small business owners or entrepreneurs, that this country wants to see our commercial class succeed. I mean, that's like a foreign language to the Biden administration. I mean, they had no connectivity with American business. The Trump administration is very connected in a very different and profound way. But having said that, the tariff policy has had incredibly uneven impacts across the commercial landscape. I mean, I really do feel sorry for the small and medium-sized businesses that are single source in terms of their goods from Asia, who are now seeing tariffs that are at levels that are unimaginable in the context of their business model. They're really going to be in a world of hurt over the months ahead. And they're not going to have the flexibility that a large conglomerate will have in being able to re-architect supply chains and navigate around these issues. So that's an area that's quite painful to watch. The impact on farmers. I mean, the Chinese have voted very clearly to buy their food products from other countries. And it's really hitting the American farming community quite hard. That's painful to watch play out. The immigration policies, I must say, I scratch my head over. We as a nation are facing a birth rate that's below that required to maintain our population. So unless the United States actually wants to shrink in size over the next 50 years, we're going to have to permit immigration. And I would think that our policies would be around trying to encourage the best and brightest from around the world coming to the United States and building careers and building families and building roots in our country. You know, I've long said every single student in the United States with a STEM degree should get a green card stapled to that diploma and a path to citizenship. You know, roughly 50% of all the Silicon Valley startups are started by immigrants. I mean, it's just remarkable how this country has won in the global war for talent, and we should continue to pursue that aggressively. And then on the millions of people who came across the borders in the last several years, you know, I applaud the president for controlling our borders. It was really important to stop that flow of illegal immigration. And unfortunately, as you and I both know, a number of countries in South and Central America didn't send us their best and brightest. They did empty their prisons and send people to the United States that we really should not have welcomed warmly. So I applaud the president for shutting the borders. But those who've come to this country who have placed roots here, who are working and contributing to our economy, we should find a path for them to be able to stay here and continue to contribute. They're important in agriculture, they're important in construction, they're important in the leisure industries. They do a lot of jobs that'll be damn near impossible for us to fill with American-born laborers. That's just gonna be really tough. And what gets lost in some of the debate is they're not taking jobs from Americans by and large. They're actually playing critical roles that help American businesses thrive and succeed, that allow us to employ more people at higher wages across the broader economy. So I think when it comes to immigration writ large, I think we've come off the rails, and we really do need to rethink our policies. First and foremost, the president was right to close the borders, but if you're at Home Depot in the morning looking for a job, that's not where ICE should be trying to find the person to deport.
On attracting the best and brightest, Citadel has been doing that. Do you worry about your hiring in the future because of the visa policies?
I mean, you know, fortunately, we're in a sector of the economy where a $100,000 one-time cost to hire a person is not going to be make it or break it. I worry far more about the brilliant student in India who doesn't come to America, or the gifted student in mathematics and physics who chooses to stay in China. I mean, I was in China shortly after DeepSeek was announced. Let me tell you what the Chinese were profoundly proud of. Not one author on DeepSeek was educated in America. It was a point of national pride in every meeting I went to, was the profound pride that not one person who authored DeepSeek was educated in America.
That has a lot of consequences.
It has dire consequences.
Longer term. What are you expecting from the Trump-Xi meeting that we may get before the end of the year?
I mean, what I would love to see is détente. I'd like to see the relationship reach a point of stability. Right now, it's two great superpowers that are trying to find a new equilibrium. And so long as we are both competing from a position of self-interest in a world of 7 billion people in a rapidly changing environment, you're going to have points of friction. And it would be wonderful to see that come later this year, that President Xi and President Trump are able to find, in some sense, a more constructive set of rules of engagement, that both countries are in a position to both prosper and to meet the needs of their citizens and have less tension between our two superpowers day in and day out.
Do you worry about the world fragmenting?
No, the world has fragmented. Like we're
to a point of no return?
So the question is what is the long-term ability for the United States to play a pivotal and influential role in the development of Africa, South America, and most of Asia. Asia ex the most developed countries. And I go to Africa several times a year. The Chinese, generally speaking, in that continent provide the power plants. They build the airports. They provide the cellular networks. So when you turn on your phone, turn on the lights, and go anywhere by plane, and it's all provided for by the Chinese. You tell me whose orbit that country's in. And the United States used to control those orbits pretty carefully. You know, General Electric was an incredible source not just of industrial might, but of policy might, because it used to be companies like General Electric that really projected American power around the world. And I would really like to see the United States be in a position to reassert that form of interconnectedness, not just through foreign policy, but through industrial connectivity. And unfortunately, as you know, the history of tariffs is that companies tend to retreat back to their domestic market, where, to be perfectly blunt, they can provide an inferior product at a higher price point to a disillusioned consumer, and they ultimately become uncompetitive on the world stage. So ironically, the administration has pushed towards higher tariffs. If we just look at the history of where this has been done around the world, it's usually a story of retrenchment or retracement from your global position to a more local position. That's the wrong direction of travel for the United States of America.
Do you tell this to the current administration? How do you navigate that relationship?
I have a team of people who are in constant dialogue with members of the administration, the House and the Senate, and we've been pretty vocal on this over the course of the last several months. I mean, you know, from my perspective, the right economic policies, the right policies on immigration, the right policies on education, the right policies on culture can have a profoundly positive impact on the United States for decades to come. And with one-party control, which is relatively rare in American history, you do have a 2-year window here to effectuate those changes and to help the president realize his dream of making America great again. I mean, I do believe that his actions and choices come from a good place, but I do wish that he had better advisors that were better grounded in economic theory in particular to lead this country to a more prosperous future.
There's been a lot of talk about Fed independence. How should we view that? Is it noise, or is there a real danger of that?
Look, I think it's a very different. Let me just give you the succinct answer. Why does Fed independence matter? Because from time to time, the Fed has to make choices that are really politically unpopular. That's why you want Fed independence. You want the Fed to be independent so that when you have to raise rates to break the back of inflation, it's going to happen. And if the Fed is viewed as being politically captive, which politician do you think on either side of the aisle is going to argue to raise rates and to slow the economy down and cause millions of people to lose their jobs? Can you name a politician who would do that?
Political suicide.
Right, and if you're unwilling to break the back of inflation, you run the risk of runaway inflation. And in particular, you in a profound way, you hurt those Americans who are most vulnerable, and particularly the retirees and near retirees who no longer have the flexibility in either their career or their investment portfolios to withstand the damage that inflation yields. So I think this is a huge strategic mistake by the administration, because if inflation does rear its ugly head, they want somebody to be angry with, like the rest of the American people are going to be angry with. And who's ever Powell's successor will bear the brunt, just as you know, Volcker did years ago, in making that really tough call to raise rates in a way that's painful to the American families in the short run, but necessary to protect the interests of our country holistically.
But the market has largely looked through that, right? So maybe they're waiting on the Supreme Court to see what happens with Lisa.
I think you can't underestimate just, you know, we are deep in a bull market, and there is a lot of FOMO. There's a lot of FOMO. And I just think to sort of chalk everything up to the market looks past, the market looks past, the market looks past. Crash of '87, and I'm not saying this is going to happen tomorrow. You know, the big news story on the day of the crash of '87 was, you know, Nancy Reagan had just been diagnosed with breast cancer, and there was an attack by some inconsequential Iranian or Iraqi boat on a U.S. vessel. I mean, like inconsequential. And the market lost almost a quarter of its value in a day. In a day. Like the market lost almost a quarter of its value. So I sort of think, just to sort of say, like, the market looks past all this, misses the fact that when the market chooses to change its mind, the correction can be extraordinarily quick and extraordinarily painful.
Does it need a catalyst to change direction?
I mean, in '87, we didn't have a catalyst. Now, in '08, clearly you had the continued erosion of the capital base of the banking system due to the housing market turmoil. But even the massive financial losses in '08, in the scheme of life, had very little forewarning. So I think it's very important that when you're in the money management business and you put your risk management hat on, you keep in mind that no matter how exuberant the market may be at any moment in time, when you're late in that cycle can shift in the blink of an eye.
But for the moment, it's AI valuations, right, that are propping everything up.
AI is clearly having a moment in the sun today, and the AI community is going to have to demonstrate its ability to deliver literally trillions of dollars of value. And, you know, I as an American, hope that comes to pass, but there are reasons that we should all be just a bit concerned about the speed with which this change will happen. I mean, here's a simple framework. When they invented the personal computer, okay, did we think the world was going to change in a profound way? Of course we did. But it's taken 50 years to play out. And we're still very much in the middle of the journey. AI today, large language models in particular, have been in existence for a few years. I think there's a real chance that when we think about the forms of AI that are...
And you're watching Ken Griffin, the CEO of Citadel, speaking with Francine Lacquad. You can continue watching that conversation by typing Live Go on your Bloomberg terminal. A wide-ranging interview, including Ken Griffin expressing some concerns about gold being a safe harbor asset, some concerns about the economy being on a sugar high, and of course his comments about the fiscal path, something he's talked about a lot, not on the right trajectory, basically saying that, hey, if we're not working through putting ourselves on a better fiscal path in good times, what's it going to be like in bad times?
Absolutely. Interesting comments, too, around gold that you highlight, saying that gold has taken on that role at the expense of the U.S. dollar, something that he's concerned about. Wide-ranging interview, as you said. Yeah, also keeping an eye on shares of Trilogy Metals, the government taking a stake. Balance of Power is coming up next.